All right. Good morning, everybody. I think it's time to get going. Thank you to all of you who are here in person in New York. Again, on Marathon Weekend. Bit of a challenge maybe to get here. And welcome to all of you online. It's great to have you as well. My name is Joe Burgoyne. I'm lucky enough to be part of the OIC, the Options Industry Council. I've been lucky enough to be part of that for 9 years after spending about 23 years on the floor of the Philadelphia Stock Exchange as an options specialist. So welcome to you all. Today we'll have 3 different presentations. We'll start with Dan Carrigan, who I'll introduce in just a second. Dan from NASDAQ will take us through managing the covered call. I'll then follow that up with the iron condor position, and then we'll take it home with the collar strategy. So again, it's great to have you all. Remember, the mission of the Options Education, of the Options Industry Council is for you to have a better understanding of the benefits and risks of the listed options product. That's what we're all about. We just want you to have an understanding so you can make an informed decision whether the listed options product is for you. And if you decide that it is, you go out and use it in a confident way. So again, welcome. And with that, I'd like to introduce Dan Carrigan, my friend from the NASDAQ.
Thanks,
Hello,
Joe.
Dan. Why don't you take it away?
Well, good morning to everyone, and greetings, investors. Welcome to Times Square. So we would promise you a little sunshine. Maybe we can get a little more positive energy going here with our options education today. Just a few blocks from here, you might have walked past the world-famous NASDAQ market site. It's where we open and close the markets every single day. We do like to call it the crossroads of America, but we also like to call it the crossroads of where capital meets innovation. And hopefully, with today's 3 educational sessions on options, you'll find innovation that has been present in the options industry since 1973 to pair with your capital. So today's presentation, as Joe mentioned, is managing the covered call, or what I like to call a retail investor's first look at options trading. So before we get going, let's just take a few minutes to take a quick look at the disclaimer. Before engaging in any type of options trading strategy, you should consult with what we call the options disclosure document, or in the first paragraph, the characteristics and risk of standardized options. It's available at the address here, and it's also available on the Options Clearing Corporation website. Today's presentation has a number of hypothetical trading examples. And in these examples, commissions and fees are not included. But these are obviously an important part of any trading decision that you'll make. So we encourage you to look at the totality of any strategy as it relates to you in terms of brokerage commissions, and super important, how it might affect you from a tax perspective. And of course, as Joe said, today's goal is to provide you with a baseline review in terms of education. But we encourage you to take today as the first step. Talk to your broker afterwards. Talk to your tax advisor. And most importantly, ask the question, are options right for you in terms of your risk tolerance for your trading account? So with that in mind, a quick look at the many resources that are available from OIC. It is an unbiased educational organization, and there's a huge stack of educational webinars posted at optionseducation.org. If online is not your thing and you want to grab a podcast to go on the way to or from work, those are easy to pull down as well. And of course, today's presentation is to give you a look-see at initial strategy, but we're not going to leave you hanging without a follow-up resource. The email address that you have at the bottom of the slide, options@theocc.com, can be utilized for any question that you might have about a strategy. Of course, you're going to have a wealth of resources from your broker online with their own educational, but we wanted to provide you with the means of a follow-up loop if needed. So what is the OIC? It is supported by 5 exchange operators. Probably all these names you've seen or heard about in the daily news. We all offer the same thing. Options on Apple stock. Well, options on Microsoft. Options on all the listed stocks that are in the country. And the purpose of that is the formation of what we call a national market system. So what does that mean to you as a retail investor? Well, the good news is that the way we are all organized is that it doesn't matter where your broker sends your options order to which exchange. All of our exchanges are linked together. Therefore, if there is a better bid or a better offer on another one of these exchanges, we will send that order to the exchange. So you as a retail investor are always guaranteed to go to the exchange destination that will give you the best fill. That's the promise of the markets. That's what we call market structure. That's what is the integrity of options in this country for you as an investor to know that your order will always be filled at the best marketable price. So I don't know how many of you are new to options, or if you have a little bit of history, maybe you've dabbled a little bit, but options have a rich history from their founding on April 23rd, 1973. That time, there was only the introduction of call options. Put options would follow a few years. And as you can see on the screen, volume was pretty much lackluster. But then, about 15 years into the evolution of the markets, various players seem to find the magic of options, which provides you with new types of trading opportunity that you simply can't get from a long or a short stock position. As you can see, with early 2000, we've basically been in a hockey stick formation to the upside. So whenever you get into a new investment strategy, and in this case, looking at options, everyone is very well aware of the robust activity of the U.S. stock market. What you might not be aware of is the robust activity of the U.S. equity and index options markets. I have kind of a metric in my back pocket that I like to use, is that on any given day, when you look at a stock, you'll pull up on your broker platform, and you'll put in the symbol, and you'll see what the size of the bid and the ask is. That gives you a chance to understand how deep the market is. But behind that stock, maybe like Apple, there can be over 500 different options that are available for trading, which also have a deep bid and offer. So I kind of like to say, whatever you see in liquidity for an underlying stock, you'll see something around 13 times that liquidity in underlying options. So the sum of the story is very simple. The options market affords a great pool of liquidity for you to get into a trade, and I think more importantly, great liquidity for you to get out of a trade. So moving on, today's presentation bases on what I like to call the pillars of trading. And here we have two pillars. One is planning, and one is managing. Today's presentation on covered calls will take a look at putting on initial position, what does it mean, and what happens when things go your way, and maybe more importantly, what happens when things don't go your way. And of course, this is your time and your opportunity to get a look at a new strategy. If you want to stop and say, look, I got a question, how would this affect? Happy to engage in any type of conversation. Please feel free to interrupt at will. We're happy to take all questions and work through any ideas. So I always believe there's no bad question. The only bad thing is not asking a question if you have a concern. So covered calls. I was just going to hope and ask the crowd, or if I could just get a show of hands, how many are familiar with the covered call strategy? All right. So good number of you. And maybe you'll agree with me with what I said, that this is probably the best first option strategy that a retail investor should look at. Why? Because it provides them with something that we're all interested in, and that is an opportunity to gain additional yield, additional returns from our portfolio. So what is the covered call strategy? It is the simultaneous purchase of underlying stock and the selling of a call. Now, as everyone's aware, shares trade in round lots of 100 shares. Each option underlies 100 shares. So at any point in time today, we're simply going to discuss an example of the simultaneous purchase of 100 shares of stock and the sale of one call, which represents 100 shares. And the great news is that your broker has already provided you with the functionality to do this as one trade. We call it in the industry, we call it a complex trade. I like to call this a simple trade because you just simply put in the net differential to your broker of where you're willing to buy that stock in relation to the call. Now, as mentioned, the primary goal of this strategy is to increase returns. And this is only so good as terms of planning your strategy and what your forecast is for the stock. A covered call strategy is best suited for those that have kind of a neutral to sideways to mildly bullish outlook. But I'll cut to the chase. The reason why I like covered call strategies is that you can do them over and over and over again. And it's probably the one strategy that will allow you to repair stock trades that have not gone in your favor. So I think if there's one takeaway today is that in the options industry, there are numerous complex trading strategies. Every one of the brokers will support up to 10 different legs if you could come up with a 10-legged option strategy. But the covered call strategy provides you with the retail investor the opportunity to repair stocks that have gone wrong, but also enhance yield. But at the same time, you have definitive risk. And we'll cover that in a little bit more detail. So what's your obligation if you were a covered call writer? So when we talk about the options industry, we call it an options contract. And that's exactly what it is. You are entering into a contract with the other side of the trade. You don't know the other side of the trade. It's anonymous. But you are making that obligation that you will sell stock if the other side of the trade says, hey, deliver shares. So you didn't sign a piece of paper, but you sure signed one with your broker. Your broker approved you for options trading, and now you are in the contractual obligation phase of delivering stock if you are assigned. And this assignment can happen at any time before expiration. You might choose an option that's 1 week from today, might be 1 month, 3 months, 6 months, doesn't matter. The buyer of that option contract has the right to call from you shares at any time. But the good news from your perspective is that when you enter into the call transaction, you get to keep the premium that you sold for that call. It's a credit in your account. So yours to keep if assigned. Now, in terms of strategies, we're all here because we're looking for ways to improve our investing experience by looking for yield enhancement strategies with options. And it's important to note in terms of any of these strategies to find where the risk sizing fits for your portfolio. And we like to stress at the exchange level, you should only enter into options strategies with risk capital that you can afford to lose and that you have consulted with your tax advisor. So with regard to the covered call trade, the upside profit is definitely limited because you're buying on one hand shares of stock, you're selling a call which gives the right to somebody else to take it away from you. So if there's a corporate buyout and that stock goes up 2 times or 3 times, goes through the moon, you're not going to get to participate on the upside. You will get to keep the premium that you were credited at the point of entry. But the good news also in terms of the covered call strategy is that it is super easy to figure out your break even. I like to call it the pain point. I want to know where I'm going to have pain in a trade. And that simply is the numerical difference between where you purchased the stock and subtracting the price of the call premium that was received. But here's the disclaimer and really, I think, the eye-opener that's important for everyone to recognize in a covered call option strategy is that you have downside. You have the absolute risk of the value of that stock going to zero. Now, it's up to you to choose a stock of which you're comfortable to enter into this transaction. But you should never take for granted the fact that that company may not exist overnight. Could have a lawsuit, something can happen. That risk is present in every one of our investment strategies where we are long stock. So indeed, the covered call strategy offers limited downside protection, but at the end of the day, it does provide you with the means to enter the trade, with a means to look at what your risk, your profit, your break-even, and risk. And we'll look at that in terms of an exact example. So the strategy that's presented here, and you can pull down the slide deck from the OIC website if you want to go back and say, look, you went through a section too fast for me. I wasn't sure on it. I wanted to take a little bit of time. This is your baseline slide, slide 11. And this assumes that you as an investor will purchase that great American company, XYZ, which shares are trading at 52. So you'll buy 100 of these shares at 52. And again, in terms of the pillar of your trading strategy, you have an outlook of neutral to mildly bullish over the next time frame, in this case, over the next few months. What's your goal as a retail investor? You're happy that you can get 2% on your money in money markets now. You only got 0 a couple years ago. But when you look at covered call strategies, you might find a way to make 8, 10, or more % on an annualized basis. Of course, that comes with risk. So the covered call strategy gives you a wherewithal to generate additional returns in excess of money market rates, again, with the caveat of having downside share risk. So let's look at the simultaneous sale of the call option in this strategy. We purchased 100 XYZ shares at 52. At the same time, we sold an XYZ 55 call at $1.75. So what's a $55 call? That's a strike price. That's the contract that I mentioned that you entered into with the counterparty or the buyer. There's an actual electronic contract that says you will promise to deliver 100 shares of XYZ Corporation at 55 to that buyer. So I'd ask you to focus on just 2 columns, the one on the far left and the one on the far right, and forget the ones in the middle. And the one on the far left is kind of a look-see at a movement of stock prices up and down. And the far right side is a calculation of net profit and loss. So if you focus in the middle at 52, let's just assume we're going forward to expiration. We don't say in here what the expiration is. We say a few months. But let's just say we've turned the magic time clock forward. And therefore, you can find that we have come to a point where the stock is now at 52. You own 100 shares at 52. You're in the same position you were a few months ago. But you're able to keep that call premium of $1.75, and that equals $175. The one takeaway that I always suggest to any retail investor is that options are made complex because people want to make them complex. But at the end of the day, there's one common denominator, and it is a simple multiplier of $100. Anytime you calculate profit and loss, if you look at the option points, just take it times $100, you'll be able to calculate how much money you're going to keep, how much you've won, and more importantly, how much money you have at risk or how much you have actually lost. So $52 at expiration, you get to keep the call premium. You've made $175. But your strategy of neutral to bullish has actually come true. And on the left side, the stock's increased to $55. Well, now at that point, you've got a little bit of a different scenario. You have a $3 gain on your stock position, 100 shares times $3, $300, and you have that $175 from the call. So you have a net profit of $475 or $475. That's about, let's see, 4.75 divided by 52 is around 8%. So in a couple months' time, that's a nice return. But look what happens when the stock goes up to 60. Your profit doesn't change. You're capped out. Why? Because you made a contract to sell at 55. So you're unable to take advantage of that further upside. I think that's clear. But what should be really clear is if you focus on the hard lower right-hand corner of the slide, as that stock goes down, you only are at a pain point of your stock price where you purchased minus the call premium. And as you can see, as the stock goes down, you're losing dollar for dollar on the stock. And this is what it looks like in terms of a chart. the frank reality is that covered call strategies work perfect in sideways to bullish trends. They don't work when the stock has a washout. But we do have a little information here today on how to repair that stock strategy, if of interest to you, rolling down, but also to take advantage of another scenario. You now are wildly bullish. Maybe you'll roll up the call. Now, in terms of today's presentation, there's a ton of slides. And not every slide we can spend a lot of time on. But again, we encourage you, optionseducation.org will provide you with the means to pull down this slide deck and go ahead and go through it in a little bit more detail. So as we mentioned at the very beginning, I like to call any type of options strategy having pillars. And with any pillar, you need to start with a plan, right? You build a house, you need to have blueprints. Well, your financial house also has to have a blueprint. And what I mentioned before is that you should only consider option strategies based with risk capital, capital that you can afford to lose, or that you've talked with your broker and it fits with your risk profile of your portfolio. So you've got some considerations to make. You set out to buy XYZ shares. Are you going to buy those shares with cash out of pocket? Are you going to buy it on margin from your broker and borrow the rest, Reg T, and pay a margin rate on it? And you also have to find what stock you're interested in. I mean, that's a personal decision. That's one that you can only decide what makes sense from your investing arena. And then the really big decision comes in on any covered call strategy. And it's kind of looking like a messed up acronym at the bottom. But you're faced with the decision of whether to sell a call which is in the money, at the money, or out of the money. So the best way to look at that is simply to say a stock price that is here, thanks Joe, is right here, and in the money call would be below it, and at the money call would be right here, and out of the money call would be above it. That carries with it different risk profiles, different profit potentials, but that's a big decision. We'll go through it here in a little bit. But at the end of the day, with your contract that you've sold in terms of the option strike, you're going to have to be willing to sell that stock. Got to depart with it. And also, we encourage you to look at a stop-loss point. Only you can determine how much risk profile you can handle. But I'm sure we've all been in stock trades where we've seen them go up and we've seen them go down. In terms of risk profile, certainly important to have discipline, or what I like to call emotional discipline, which is kind of an oxymoron because you don't want any emotion in your discipline. You want to have a plan where you know where you're getting out when you're wrong. Now, the nice part of the potential plan for covered call strategies is that you don't have to have it on your favorite stock. You can do this on an exchange-traded fund, an ETF. Could cover the stock market. Could be a commodity, covering U.S. oil. Could be anything that you want that has optionality, an option based on it. So the covered call strategy in all instances will provide you with a means of portfolio diversification across all the many sectors that the equity markets provide packaged in various exchange-traded funds. For example, countries, maybe like Brazil, hot in the news with elections, covered call strategies there, Turkey, China. The world is yours. You're not limited to covered call strategies simply based here in the U.S. And I also mentioned is that given the fact that a covered call strategy is based on your determination of what time frame to choose, could be a week, could be a month, could be 3 months. You have the wherewithal that once that trade is finished to rinse and repeat over and over. So at this point, we've gone through what the strategy is. We've gone through twice in terms of certain planning characteristics. I'm just curious if there's any questions anybody has from the audience in terms of where we are. Yes, sir.
You said that it's something that's applicable like worldwide. Is this what you're saying?
Correct. The question was, is the covered call strategy applicable worldwide? And the answer is yes. So any exchange-traded fund that is available for trading today, of which has options listed, can be utilized to execute this strategy. So you might have a portfolio where you have 5 different stocks that are income producing. And you may say, I like the income. I like the dividend. I don't want to get rid of those stocks. Covered call strategy wouldn't make sense on those stocks. But you might have a view on a country stock. For example, the China ETF, symbol FXI. A lot of concern with tariffs right now. So maybe you're feeling the clouds are going to part and there's going to be some type of a deal between the US and China. You may actually purchase shares of FXI and simultaneously sell calls on that position. Now you've got the opportunity to do the exact same thing, enhance income, take in more money, and play a country. So you're never limited by country. You're never limited by asset class. There are ETFs where you underlie soybeans. SOYB, for example, options, has the wherewithal to trade. So it depends what risk tolerance you have for your portfolio. Thank you for the question. May I ask if there are any questions? Yes, sir, please.
Usual tax rules on capital losses and capital gains, they still pertain for options?
Correct. So the question is on tax treatment of equity options. Although we can't provide you direct tax counsel, all equity options, profit and loss, are considered short-term capital gains if they're within a year, which rolls into your ordinary income.
The stop loss point, is it on the option itself or on the underlying stock?
Thank you for asking that question. The question was, is the stop loss point on the underlying stock or on the option itself? So in the first instance, you as an investor need to determine where your pain point is as the stock goes down. So in the example that we have here today, we bought 100 shares at 52. We sold a call at $1.75. So 52 minus $1.75, we're at $50.25 is our break-even point. So you have the wherewithal to decide where to exit. You could put a sell stop in your stock below. And at that point, if that gets elected, maybe you say, look, my pain is at $45. Get me out. The market trades to 45, and now you've got a decision to make. Immediately cover your short call, but the stop loss will always be in your underlying stock. But it will be together as a package. It's a great question. Please.
If you own a stock, what tools would you use to determine your strike price and the duration of the expiration date? Would it be technical analysis, fundamental analysis, use of some kind of calculator? And how would you know if the premium's out of whack? So maybe it's volatility or something. It's too much of the premium. You get too much or not enough.
So the question is how to find the covered call strategy that makes sense for you as it relates to the price of the stock, which strike to sell, and which time frame. Each of the online brokers provide basically a trade search mechanism. So you have the wherewithal to put in the underlying stock symbol and the time that you want, 1 week, 1 month. They will provide for you a listing the stocks in relation to its annualized return on that strategy. In other words, you buy the stock here. If you get exercised, how much that will be as a result of the trade. So I encourage you to consult with your broker. They have wonderful online functionality that will provide you these what-if scenarios. I trust you have an online securities account. They have a screener. They have an option screener. I'm a Fidelity customer as well. I have a number of it, all the brokerage. They all provide that because another way of answering that question is you don't have enough time on planet Earth to look at 500,000 different strikes and 3,000 different stocks. They'll provide it for you. So I encourage you to go to fidelity.com as well as any of the broker dealers that are available. Yes, sir?
In theory, if you have a long stock and you're short a call, you have an equivalent of a short put instead of selling the stock and then having to deal with the option as well.
I love the question. So, hey, you've got a trade on a covered call, long stock, and short a call. You know, you're basically a synthetic short put. Should you take the idea to create a downside hedge by buying an out-of-the-money put? The answer is that's up to you in terms of your risk profile. Today's presentation on covered calls just gives you the plain vanilla parts of the strategy. But in terms of repair, you have the wherewithal to do whatever you seek. But logically, yes. If you believe that you want to buy additional insurance, you could buy an out-of-the-money put. It's no different than you deciding what your deductible is going to be on your car. Do you want a higher deductible or a lower? It's going to cost you money. So,
And, that's a lead into the third presentation today.
Yeah.
On the collar strategy.
right, so we'll go through that. You have a stock, selling a call on the upside, buying it to finance a put on the downside. So we'll go through that. But I'm glad you raised the question, because this basically comes in, and the question over here in terms of what do you do when you're managing this position, how to get out, where to get out. These are a lot of considerations, and something you should always be aware of. Let's say, the gentleman here, you mentioned, I use an example, you might have income-producing stocks. Let's say you wrote a call on that. If there's going to be a big dividend, likely the buyer of that call contract will exercise it the day before the next dividend date, because they want to be the owner of record and they want to get that dividend. So those are also considerations. You might own that stock. You might be able to collect that dividend, but the stock might be taken away from you and you no longer get that dividend. And as we mentioned a little bit before, in terms of repair, what happens when the stock goes up? What happens when it goes down? The one thing that we really want to stress, and I'm very appreciative of the question over here, is let's say you have a sell stop in that stock. It gets elected. You've got a naked short call in your account. You can be assured your broker's calling you. Do you have enough money? Short positions in any option require a lot of margin and broker approval. So they provide a lot of risk, and we always suggest don't leave that short call out there. Simple as that. So in terms of strategies that we talked about, let's say your stock is a wonder stock. Now it's going to go up, maybe another 10, 20%. Here's a simple idea is that, hey, you might have originally, the stock was higher in this example, and you actually sold an $80 call. You might say, look, I think this stock's going to go $5 higher. So you have the strategy here. You could buy back that $80 call and now sell a higher call at $85. So all this takes consideration of your strategy. And of course, it takes something near and dear to all of us, and that's money. Maybe the stock's gone down. We talked a lot about the risk profile. Can you roll down this strategy? You sure can. You could buy back that short call that you sold at initiation, that $55 call. In this case, you can buy back, in this example, an $80 call and sell a lower call to take in some more premium. And this is all going to have an effect on profit and loss. But the good news for you and the takeaway is that whenever we're talking about buying this, selling that, it kind of leads to confusion like, look, I can only point and click with one finger at a time. How am I going to find this? How am I going to find this strike on my broker website? How am I going to get that executed and go to the other one? The good news is you don't have to. All brokers provide you with complex order functionality. To roll a covered call strategy up or down, you can simply execute a call spread, two-legged spread. Your broker will provide that with you. It'll be just the spread differential. Be sent into the exchange, will be executed. 2 legs, guaranteed the price spread. The nice thing is that eliminates leg risk. No one should be concerned with having to go out and say, let me buy back my call, and let me go sell another call. And now you've given up the bid ask on 2 different strikes, and now maybe the market's moved, and you're like, man, this just didn't work out. So the functionality of your broker, the exchanges provide you with the means of price certainty when you roll up or down a covered call. But as we've gone through today, the key to the covered call is that you've got to have a predetermined stop-loss point. You've got to know where your ultimate pain point is. And that's something that you can only determine with your risk sizing for your account in discussion with your broker or, frankly, with your tax advisor. And I think that all of us spend a lot of time, and I think the gentleman here asked about technical analysis. I like technical analysis quite a bit, and I try to forecast on stocks that I'm interested in. But at the same time, I always know where my tolerance is for risk. And I try and basically deploy what I call emotional discipline. Again, the oxymoron, where it hits my price on the downside, I'm out. But we encourage you, not only today as a first step in terms of education, but your broker-dealer has a wealth of educational materials as well on their website. And they're always going to pick up the phone and be able to walk through a strategy of any sort. So let's go back now to our initial covered call position and see where we are. Remember, we bought 100 shares of XYZ at 52. And now we're thinking, hey, stock's at 59. We're going to buy another 100 shares. Why not? Stock's going up. You're bullish. So you're figuring this is going to be an upside movement of at least almost 10% in the next 90 days. So at that point, you elect to sell a March $60 strike call at $4. Again, this transaction is done simultaneously through your broker, the purchase of 100 shares, and the sale of one call. So again, $59 is my long position on stock, and I am short a March $60 call. Took in $4 of premium. So what's this going to do for me in terms of profit and loss position? We know one thing. As soon as that stock goes above $60, somebody else is going to be saying, I want that stock. That's fine. At least you know this. You know that you're going to get to keep that premium. You know you're going to get another $100 profit when you sell at the $60 strike. So what's your out-of-pocket exposure? We talked about that earlier in terms of how much you can risk. So you purchased 100 shares at $59. Normally, you'd have to pull out your pocket $5,900. But in this case, you've sold a $60 strike. You're taking in $4 of premium, or $400. So your total investment out of pocket is $5,500, or up per 100 shares, $55 is the stock price. That's what you call your break-even point, or what I like to call, again, the pain point. So what happens here on profit or loss? It's really the same story as we had earlier on. As the stock goes up, you're going to find that I think you should just focus on the far right-hand the far right-hand column and the left-hand column in terms of stock price. Let's say we get to 59 at expiration. Once again, your stock's gone nowhere. That's okay. But that $4 premium is yours. So you get to bank that $400. You're going to be happy paying the tax man on that. And then as the stock goes up, you only have potential for another $100 profit. Why? Because once again, you sold a $60 call. So the stock that you bought at 59, you sold at 60. You get $1 times $100 plus your $400 premium, $500. But look at the downside. That's the concern. That's, again, where you need to be focused on. And remember, we established our break-even point at $55. So as the stock goes down to $50, we've lost $500. So as we focus quite a bit in terms of shares down, let's go through an example. And before I go, just want to see if there's any other follow-on questions from the audience. Yeah, please.
This is selling, doing a cover call, right?
Correct.
I do the opposite. Let's say I sell it with the option to buy at, let's say it's at 50. I want to buy it at 55. So I put out the order, sell XYZ shares at 60. Right? I have to have the money to cover my position. I'm doing the selling. I got a premium.
Mm-hmm.
If you don't hit 60, I keep the money. That's the opposite of doing the same thing. Am I right?
You're suggesting if the stock goes up, you would sell it. Is that
I'll buy it.
You would buy it?
I'll buy it. It's at 55. I said if it goes to 60, I'll buy it at 60.
Okay.
Okay? I need I need capital to cover my position. Somebody's going to give me XYZ, let's say $400 in 30 days. I like 30 days. I like short term. If in 30 days you don't hit 60, I keep the premium.
Right.
And I do it over again. That's the same thing with
Right.
cover call, but doing it the reverse. Warren Buffett does that. Makes a lot of money.
So you're suggesting to reverse the covered call?
Yeah, but it's still a cover call. But selling the puts.
Right. So selling puts is definitely an opportune strategy. So the question basically is, hey, what's the reverse of a covered call strategy? So selling a put is another great entrance for a retail investor who wants to get long a stock.
Yes.
So when you sell a put, you put that money in your pocket.
Right.
Stock goes down, the stock will be assigned to you. You must buy it. But you're happy because you can buy it lower than the price.
No. The opposite. I'm selling it. It's at 55, I say I buy it at 60. Right?
You're selling the call or the stock?
I'm selling a put.
Selling the put.
But it's a covered put.
Okay. Maybe what we could do is during the intermission talk about that. Why don't we go through the rest of the presentation because it's out of scope, and I'd be happy to go through the scenario.
Okay?
Yes, sir?
How about if you wrote a covered call and the stock splits 2 for 1? What happens to your call?
Great question. What happens to your open option position if a stock splits 2 for 1? The Options Clearing Corporation will declare a new deliverable with a new symbol, or it will double it in that case. So you will still have the initial economic position. Each of your brokerage firms has a section of treatment of corporate events, which is what a stock split is. Stock options are not adjusted for regular dividends, but for almost everything else they are. In the case of an extraordinary dividend, a two for one split, a reverse split, an acquisition. And you will be given certainty by the Options Clearing Corporation to your broker what your position will be. But in all cases, you will never be economically imperiled. You will always have the same economic position. In that case, a 2 for 1, you'll have twice the shares. So
The option is the stock will split.
it'll just be a deliverable, correct.
So
You'll have 200 shares, 2 options.
2 options.
Huh?
Yes.
Thank you. I'm glad you raised that. Corporate events are always a stickler and important to know and to be aware of. So in terms of looking at the strategy, just to go forward, we've got about 6 weeks now to expiration, so not far from your 30 days. And we know that our break even on that trade is $55. So the March call is at $1. So you were kind of moderately bullish over time in March to get to 60. So in this case, it says you could do nothing. It claims it's a risky tactic. Risky is only defined by what you think is risky. But here is the problem. The stock's plummeted, and it continues to plummet. You're going to have additional losses, and you're bearish. So you could get out of that position. We mentioned you could put in that sell stop. You can get out. Take your loss on your XYZ shares. Buy back that 60 call. You got your loss defined. You live to play for another day. Or you could do what we call rolling down the position. With 6 weeks to expiration, you could look at that break-even point and go, I've got a loss potentially on this March 60 call at $1. And now I'm no longer neutral to bullish. I'm neutral but defensive. So I want more call premium. So you're willing to give up a little bit more of your upside profit, and you're willing to sell your shares a lower strike. So you can roll down with this strategy. So the next strike below is a $55 call. So remember, and again, this has 2 columns. I'll ask you just to focus on the middle column. You came into this position, long the stock, and short a $60 call. And now you're saying, hey, I think that stock's going to be below $55. With one simultaneous purchase, you can purchase back the $60 call and sell a lower $55 call to take in premium. Now, that means you're going to have to pull some money out of your pocket. That lower call is going to give you a premium of 3 points. But you have to buy back that short call of $1. So the net difference is $2 out of your pocket. It's going to lower your break-even price now. That's the good news. You were at a break-even of $55. You now go down to $53. But you also have to keep in mind your legal contract in terms of your option position is now you are obligated to sell XYZ stock at $55 because you're no longer in the $60 call. So your maximum profit, if you recall on the chart, no matter how high the stock went, was $500. But to roll down this call position, you had to spend $200. So you've actually reduced your profit now by $2. And this is the graph that gives you a look at the profit and loss. I'm going to roll forward through this. And now look at where you are in terms of your profit and loss. Yep, definitely a little bit lower. Your break even is now 53. You've accomplished your goal of rolling down your risk with a covered call strategy. And you can see here, now my break even at 55. Excuse me, I was going to say 53 is now my new break even by rolling down. I'm going to ask you to focus on the right side. Has it accomplished your profit and loss potential? On the upside now, you can see you've only got $200 of upside. Before you had $500. But you have reduced your overall risk. And your downside now is going to go dollar for dollar as it goes below 53. So in terms of that short call out of the money, we look at how XYZ has declined. And in terms of this $60 call, it's far out of the money. There's no action required to let that call expire at expiration. It's just going to expire, and you can look to do another short call against this position. That's the best part about the covered call strategy. I said earlier in the presentation, I like to call this the rinse and repeat strategy, because each time you hit an expiration and your call was out of the money, it expires. You've got a new opportunity, a new day to be able to sell a new call. But keep in mind, if you got out of your underlying stock on that Friday, you may have a large margin call. You don't want to go into an expiration at any point in time naked short. Your broker will definitely have an opinion on that. So we've talked a lot about risk. We've talked a lot about how to manage the downside. Let's go to the sunny side. I think the clouds are parting outside here in Times Square, Joe. So let's look at how now the bullish sun has come out and what we could do to roll up. So again, we come out to 6 weeks from expiration. And your stock, that great American company XYZ, has increased from $59 to $64. Well, that March $60 call now that we had sold at $4 is now worth $5.25. Calls increase in value as the stock goes up. Our profit unrealized is still $375. But you are now much more bullish on this stock. You think it's going to go about 8% higher from $60 to 65%. So you now have a decision to make. You want to seize on the potential for additional profit. At the same time, you're going to also have additional risk. One of your strategies here may be to roll up the call. So the next higher strike in March, above that $60 strike, is simply a $65 call. So again, let's keep in mind what our initial position was. We're long XYZ shares. We're short a $60 call. We want to now be short a $65 call. So we will go to our brokerage website and enter a complex order, a simple call spread, to buy simultaneously the March $60 call and sell the $65 call. And at that point, it's going to cost us some money. I mean, we're buying back a call that has really increased in value, and we're taking in our pocket a slightly higher call. So now it's going to cost $300 out of our pocket. And that means our break-even price is going to increase by $300. Got to get that stock up to $58. That's our new pain point. With it, though, comes with the obligation of the contract that you will sell at $65 if assigned. But here's the silver lining in the bullish strategy where the clouds have cleared, is that your maximum profit potential has increased from $5 now to $7, or $700 total. That's a function of the higher strike price. Here's where we started out with the $60 call. Here is where we roll up to the $65 call. Break-even price $3 higher, more upside potential higher. Again, focus on just two columns, the stock price on the left and the $65 call on the right. Remember, we said our break-even price is $58. So at expiration, we're not making, we're not losing. But for each dollar above, we're going to make $100, all the way up to our strike price of $65. So we have that capability now to earn $700 on the position. But you can see, importantly to note, lower right-hand corner it gets redder and redder as the stock goes down. I think that's clear. So in terms of these strategies, this allows you to adjust your thinking of where you want to be in this trade. And of course, in this position, we start out with a $60 call, and you just weren't willing to give up your stock at $60. So you have that ability on the upside to roll it up. Be willing to sell it at 65. Or, as we talked about earlier, to roll down. But keep in mind, the covered call strategy, again, if there's one takeaway, you should be very aware of the ex-dividend date. Because if that stock is in the money, there's a big dividend, somebody out there is going to want that stock out of your hands to collect that dividend. I think in terms of the trading strategy that we just went through, all these decisions are reflective on where you want to maintain your investment horizon in terms of cost basis. So I'm going to move through this and just get to kind of our end zone here in terms of what we like to call common misconceptions. But before we jump into this, I just want to see if there's any more questions from the audience in terms of today's strategy. Yes, sir.
So you mentioned the weekend risk. Let's say you don't cover your call on a, when you don't do a spread, you do a new call on a Friday, keep any other call. 4 o'clock p.m. last print, that's the price, right? It doesn't really matter on the weekend, right? 4 o'clock last price is the last print is the
Right.
deal, right?
I think you're asking, have I covered the short call, and now do I have a new short call going into
Well, no, I'm just saying the 4 p.m. last print, that's the price of
Correct.
the options. It doesn't matter what happens
Correct.
after hours or Saturday.
That is correct, but again, the exercise of the stock is going to be dependent on whether it's in the money at expiration and any time on that day up until 4 o'clock. Given these are American-style options, these can be exercised at any time. So you are correct. The only thing that you know is 4 p.m. If it's out of the money, unlikely they're not going to exercise unless there's some reason that they want the stock for a reason that we don't know.
When do they have it? When's the latest you can exercise? Is it 4:15 or 5 p.m.?
Great question. That question is when you can exercise. Each of your brokers has their own policies and procedures, and they will give you a cutoff time that may be different than the Options Clearing Corporation. So we encourage you to check with your broker. They may have a time 5 p.m. Eastern, 6 p.m. I don't know what that is, but you can easily find that by calling them and finding. That's a great question. Thank you for asking it. Yes, sir.
Instead of using stocks, could you use like a long-term option, like a LEAP, and then write monthly options on that instead of having physical stock?
So you've asked a great question. Could you create a covered call strategy where you don't actually own underlying shares? You own a LEAP, a long-term option greater than a year as your underlying, and sell short-term options on that? The answer is yes. It'll be subject to your brokerage approval, but then that creates kind of a different risk-reward profile. For example, if your stock pays dividends, you would not be entitled to those dividends, but you could absolutely do that. That's essentially like a calendar spread, but yes, that would be a complex order that's possible. Thank you. Any other questions? Yes, sir.
Is there a way to minimize the risk by doing a call and a put? Or?
It's a great question that came up. Is there a way to minimize the risk doing a call or a put? So today's presentation is just on the covered call, but are there permutations where you could go, you know what, I want to insure my risk. So in this last example where we rolled up for profit, now we have a $700 profit, would I be willing to take any of that profit and invest in a downside put in case there's a washout in the stock? Absolutely. Again, that's up to you. It doesn't have to be the same option time. It could be a week. It could be a month. It could be whatever. But it's all a function of, here's the profit from the covered call strategy. How much am I willing to invest in an insurance policy to the downside? So absolutely, you could do that.
11:30 Eastern Time. We'll address that.
All right, perfect.
You're writing a covered call and you look at the bid and ask strike for that strike. How do you know you're getting a fair price for that strike? Is there a way to determine, to calculate if that is a fair premium you're getting?
So fair value is a function of the options implied volatility model. Your broker will provide you what the marketplace is providing, a continuous two-sided bid-ask quote. As an investor, you don't have to accept that bid-ask quote. I'm going to get to your answer. You can elect to enter a bid or an offer above the best bid or an offer below the best offer. But the marketplace is highly competitive with streaming bid and offer quotes, incredible liquidity. So fair value is already reflected in terms of how market makers see it. But your specific question, how can I tell if it's fair value? The market is telling you where they're willing to buy and sell. It's going to be up to you to say, do I accept those prices or do I want to go in the middle of them? I'm going to get to the finish here because we just got 2 minutes to go. And just to come back here, and this is, thank you for that question, because this basically reads into the slide, is that the market is efficient. All of the exchange operators are tied together to provide a national market system to provide you with what we call best execution. Your order is going to go to the exchange that gives you the best opportunity for execution. But at the end of the day, as a retail investor, there's only one opinion in this room that counts, and that's yours as an investor. Your market forecast is the most important. And in terms of misconceptions, we talked about assignment. We talked about the Friday assignment. Is it good or bad? It depends what your initial goal is. You might be very happy to get assigned and get taken out of your stock because you reach your maximum profit. It might be bad in terms of there was a special dividend declared or an ordinary dividend, and you really had your heart set on the dividend. So there's a lot of different ways to skin this cat. But the reality is that you are always looking to create a strategy with covered calls of defining your risk and reward when you go in. And it's true, if a stock goes up, you are forced to sell your winner. But you are sure happy to take in that call premium at trade initiation. In terms of a wrap-up today, the covered call strategy is best characterized in 2 words: income generation. It allows you to increase the yield on your portfolio as stocks are deemed neutral to bullish in terms of upside. And the downside protection is limited to the value of that call that you sold and took in. But the great news is that as a strategy, you can always adjust to your risk and reward tolerance. So if your acceptable assignment, we always say, have a plan. So with that in mind, I'll bring you to the end and encourage you to visit optionseducation.org to get this slide deck today. And there's a number of different educational resources, videos, all kinds of things. But we're always going to provide you with resources as an industry to help your investment horizon accomplish really one goal when you get into strategy. Do I know my reward? That's great. More importantly, do I know my risk? So thank you for attending today, and we look forward to the continued strategy presentations the rest of the day. Thank you.
We'll be back, I guess, in 15 minutes.
15 minutes. All right. Thanks, Joe.